It's Friday the 10th of March and it's non-farm payroll day. Today is the last hurdle the Federal Reserve will have before next Wednesday's FOMC rate decision, where it is widely expected that the Fed will raise interest rates by 25 basis points. Now, the probability of an interest rate hike next Wednesday is now up at 89%, so we are pretty much nailed on for that. But if there's anything that could really derail the Fed's plan and derail what Janet Yellen is looking to do next week, it is the jobs report, the US jobs report, which is due out at 1:30 this afternoon. Now, the headlines usually do come from the non-farm payroll figure, but the non-farm payroll isn't necessarily the most important number within that jobs report today. It is the average hourly earnings is the one that we have to look out for. Now, let's look at a couple of the reasons behind that. I mean, the main reason is that if the Fed are looking to raise interest rates, and the expectations are the Fed are looking to raise the interest rates by at least 3 times this year. So 3 times we're going to see an interest rate hike if the Fed stick to their plan. Now, by doing that, what the Federal Reserve are doing is they're pushing up interest payments. They're pushing up debt payments. So everyone within the US who has a mortgage, a credit card, a loan, all of those payments will be going up if the Fed raise interest rates. So what the Fed have to make sure happens is they have to make sure people can afford those debt payments. Now, the only way they can see whether the general public can afford that is by looking at the average hourly earnings figure. They have to see wage growth. They have to see this continue to move to the upside. If they don't see that wage growth and they raise interest rates, obviously we do then see a greater potential for defaults within the debt markets. And that is obviously a bad thing for the overall market. So we have to see that number move. Now, expectations for today's average hourly earnings number are for a gain of 0.3%. Now, the big fear is if that number misses expectations, of course, but if it drops into negative territory. If we see that like we did 3 months ago. 3 months ago, we saw negative 0.1 for the average hourly earnings figure. Now, if we see a negative number, that could well derail some of these plans for the Fed next week and have Janet Yellen worrying about just whether people can afford these interest rate hikes. Now, if we do see a fall, it would only be the 5th time in the last 5 years that we would see that number fall into negative territory. So the expectations don't see that happening. We don't expect that number to drop into negative territory. However, the worrying point is that it's not the average hourly earnings that gets the headlines. Obviously, the headline figure is the non-farm payroll figure. If we get a better than expected number, if that number comes in at 0.3% or around 0.3%, yes, the market will be happy. Then our attention will shift to that non-farm payroll figure. And the expectation for non-farm payrolls today is for 190,000 new jobs created. Now, if we look at that and we look at that number, over recent months, we've seen a beat of expectations. Now, what we have to do this week is go back to the ADP payroll. So the ADP payroll number comes out on the Wednesday before the non-farm payroll. And this week, when we got that number, we saw a huge number, a huge beat of expectations. What we expected from the ADP was 190,000. The number we got was 298,000, 108,000 better than expectations. Now, over recent months and the recent correlation between the ADP and the non-farm payroll has shown that if the ADP beats expectations, then the non-farm payroll beats expectations. So we can look at that correlation, and if that correlation is something that is going to come true again, we can expect a better than expected number from the non-farm payroll later this afternoon. Again, expectations for today's non-farm payroll are the same as the ADP, 190,000. So anything above that will be seen as positive. If we get a better than expected average hourly earnings figure, we get a better than expected non-farm payroll figure, then of course the Fed get the green light to go ahead and raise those interest rates next week on Wednesday, on the 15th of March, at that Fed meeting. If we get weaker than expected numbers, if the average hourly earnings drop into negative territory, then it will very much be a case of focusing in on the market reaction. Will the markets be spooked by a weaker number? Will they start to worry that the general public cannot handle and the economy cannot handle these rate hikes? That's the big question that we come in. That we have today. And remember that probability so far for next week is 89% that we will get a rate hike from the US. If we get weaker numbers from the non-farm payroll and the average hourly earnings today, we could see that probability drop. So we must keep an eye on what is an incredibly busy day when we get the US jobs report later this afternoon at 1:30.